Hello, good evening, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well?
Yes.
Good. Right. Now, so students, we are starting financial management session today. Just let me know whether you people have received this volume 1 of notes or not. Tell me. Have you received it? Okay, majority have received. The people who are saying they haven't received, they should go to the website, the same course link where they click to join live class. It is below, it is uploaded below that link, notes. Okay, the option is, so this is given over there, right? So you can just go there and can verify from there. Now, if you still didn't find, do let me know. Okay, now. So, students, let me start with my introduction. Yes, introduction. Hamza Siddiq. I have been teaching ACCA, financial management. Financial management. I have been teaching since last 14 years. This was the first subject when I started my teaching. This was the first subject I taught to my students, right? So, and then I teach audit and assurance, advanced audit, and advanced financial management. 4 subjects I teach, right? Now, so what I want to hear from you, your introduction as well, one by one. One by one. I want your introduction as well. What you will be doing, you will be opening your mic in the alphabetic order, right? And you will be telling your name and you are working or not. And you know the next you will be telling me, uh, is it your first time studying online class or you have studied before as well somewhere else online classes? So please let us start with the Ahmad Ali Asif. Yes, please. Your name? Yes.
Yes.
Yes, you're
And
working or not? And the third,
yes.
online studying. Yes, please.
Good afternoon. I am Jattu Ahmed Ali Asif. I am a full-time student at the University of Mauritius.
Right.
And it's my second time doing online. The first time I have done online is with you for the audit paper.
Right. Yes, Ahmad Ali. Thank you. Thank you. I just remember that. Thank you. So yes, the second introduction is Ashwini. Ashwini, please proceed and introduce yourself.
Hello, sir. Can you hear me?
Yes, we can hear you. Yes.
I am Ashwini Kiroda. I am currently working for the Bank of Mauritius. I've never attended your class before, but I was with the London College of Accountancy before that.
Say it again, please. Where you attended class with me before?
No, I've never attended an online class with you before.
Okay, right.
This is
Okay.
the first one.
Okay, right. Okay, I hope you will enjoy our sessions with our features. So it will be your good experience, I expect.
Thank you,
Okay, I
sir.
welcome you.
Thank you, sir.
Yes. No worries. So some people are working right now, so they can type their introduction. Okay. Oh, okay. Right. Okay, right. So yes, Arbaz, please. Arbaz, would you like to introduce yourself, please, a bit? He joined recently. I think he didn't know what we are doing. We are actually knowing each other. Yes. Arzina.
Hi. Yes,
Hi.
sorry.
Yes.
Yes, my name is Esna, and it's my first time on an online class with you, but I've taken the revision class for performance management this past December.
Okay, with our organization, with our academy?
Yes.
Okay. Welcome, Arzina. I hope you have enjoyed, and the last class. That's why you are here, and you will enjoy it further. You see the benefits of online class. Thank you for joining us. Yes, thank you. Yes, Chetan. Yes, please.
Hi everyone, my name is
Hello.
Chetan.
Yes.
I'm currently working as an internal auditor for a group companies. This is my first time. This is my first time doing online courses with you.
Right. Thank you, Chetan. Welcome to our organization. Thank you. Next, the next is yes. Keshav said he has written the yes. Right. Some students have sent me the written because they can't speak because they're working. They are somewhere in a place where they can't speak. Right. Yes, Keshav Gunis. I'm sorry if I pronounce it wrong. I'm sorry. Yes.
Hello, sir. My name is Keshav Ganesh.
Yeah.
I'm not currently working.
Right.
It is my first time doing financial management,
Right.
and second time online classes with you. The first was Saturday morning, F8.
Okay. F8, you are also studying. Okay, right. Thank you. Yes. Tushni, I'm sorry, Tushni, I think. Right. Yes, please.
Hello, sir. I am Tushni Kumar, and I am currently working in an organization, and it's my first time with you.
All right. Okay. Thank you, everyone. Now we will proceed with the financial management, the subject, and what I will be doing. I will be, that you people know your exam will be held in the exam platform. So that's why I have chosen that whatever I will be explaining in the Excel sheet. Right? And you will be having access of that Excel sheet after the class. Okay, whatever I'll be explaining. I would have written, on the paper or on the iPad, but that's what I choose for you because it will be an online platform, where you will be doing your working. So you will be learning here with me now. So students, financial management. Okay, so I hope all of you have got these notes. Okay, if you have not got this notes, let me explain you where you can find these notes. So simply, Hamza.academy, you will open our website. Yes. So June, you just log in. Okay, you will just log in with your login, and you will go to financial management. It will be shown in your batch B, right? In any way you can proceed. Here is the notes volume 1. Okay, simple click that. Here it is. Click here at top, it will be downloaded. Okay, it will be downloaded. Simple, so simple. It is available on the website now. So all the lecture videos will also be uploaded after the class below this. Every week it will be updated. Now, let us proceed. So students, financial management, the subject. The subject is quite interesting. And if I say, okay, here is the exam format, page number 7 of the notes I have given, that 60 marks are for objective test question, 60 marks, section A and B, 15 MCQs, and 3 compulsory 10 marks case studies with 5 questions each. Again, objective test. And now 2 compulsory mark, 20 mark question, section C. Now, students, the point is the syllabus. Let us talk about financial management. Financial management, actually, they say you have to think like a finance manager. Think and act like a finance manager. So what finance manager does? Finance manager. So what is financial management as well? So there are 3 types of decisions they take. They take decision of investment decision, right? They make financing decision and dividend decision normally. So you see here, this is called financial management. What is financial management? So 3 types of functions they perform. Investment decision, that a business should invest in a certain project or not. A business should invest in a certain project or not. So appraise, evaluate, and different aspects of that investment appraisal processes. Now, next point. The next point is financing decision. What is financing decision? Financing decision is basically that you need to decide how to finance your business. Equity, debt, preference share, venture capital, Islamic source of finance. Yes. And dividend decision, dividend policy of the business. How it should be made up. How it should be, dividend pattern. How dividend should be given. What are the factors to be considered? How dividend decisions affect, your business, share price. So this is what you have to, make a decision as a finance manager. Then next, so these are your syllabus, what I'm talking about right now, sections of syllabus. Then is working capital management. Again, working capital management is basically a function of finance manager. That how much investment should be done, how much cash, how much inventory, how much receivable. And again, it is linked with the financing decision. Financing decision, that how working capital should be financed. Okay, there is some electric breakdown. It is scheduled. I knew it. So it will be 30 minutes, but we will be studying. Don't you worry. I'll just switch off my camera. Okay, I'll switch off my camera. So I will continue with it now. 30 minutes only. It will be back in 30. It will be stored in 30 minutes. Okay, now. So working capital management, and then is the next is that is yes, risk management. A company which is involved in the foreign currency transaction. Foreign currency transaction it is involved in. So it has to conversion of exchange rate may cause losses for it, risk management, or interest rate may move up and down and may affect the business. So risk management is there, the section. And the last is the business valuation. Business valuation. So business valuation, that's how to value a running business. Business is not sum of its, that tangible assets, value. Sum of the value of its property, plant, equipment, property, land, building. No. What are the different methods to value a business? So if I club these sections, so I say this is one section basically in our syllabus. So 1, 2, 3, 4, 5 sections of business are there, syllabus are there. 5 sections. Investment decision, investment appraisal. It is a big area. Then finance, business finance. We call it collectively as business finance. Business finance. We call it as business finance. Yes. Now, so students, we call it as business finance, collectively section. Now, so investment appraisal, business finance, and working capital management, risk management, and business valuation. These are the section basically now of your syllabus. Now I have given you the notes, and here is the course plan mentioned. Course plan financial management. So we will start with the section investment appraisal. We will start with that today itself, 10th January, 17th, 24th, and in 4 sessions, I will try my best to what we say, complete this section. Complete this section, 4 sessions. And then is the business finance that will start in the month of February, 1 month on it, 4 sessions. And then is the business valuation. Maximum 2 sessions are required. And the next is, that is working capital management. Working capital management. That is here, 19th March. Now you see here is some twist. I want you to note it down. Till 14th March, our class will be on Tuesday. Then we will have Ramadan, this session. So in the Ramadan, we cannot conduct class this time because of the iftar, because of the prayers. We cannot conduct class. So we will be conducting class from 19th, that is Sunday. These are Sundays. These 5 then fall in the Ramadan, these 5 classes, month of Ramadan, right? Yes, Ramadan. So this is Sunday. I want to discuss with you that on Sunday, can we have class at 12 hours? At noon means on Sunday, what I have thought that the class timing will be 12 to 15 on Sunday, because majority of people have, almost everyone has weekend off. Sunday. Tell me please, will that be good for you people? Sunday? Tell me, please. Okay, good. Now, so if someone has issue, so they have the option, of course, to watch recording later on and contact me via WhatsApp if they have any issue. Okay, like this. So this is what I have thought. Then I thought, why should I change schedule again and again for 2 classes only? Yes, if needed, I can conduct 2 additional classes on Tuesdays during these weeks. On Tuesday. In this time, 2 additional classes I can conduct for additional practice sessions. So 17 to 19 classes will be there. 17 to 19 classes will be there. Now, so this is your course plan. Now, students, the financial management, the challenges. What are the challenges? Let me list down. Challenges. Challenges means things to focus, aspects to focus on. Students, first of all, each topic, majority topic has calculation part. So calculation. This is the step 1. Master the calculation. Step 2. Theoretical. Part of each topic must be grasped conceptually. In my opinion, in financial management, students do not fail because of the calculation. They fail because the reason is they don't prepare theoretical part properly. Step 3. A lot of practice of past paper and exam kit, especially objective test question, especially I mentioned, because 16 marks are for that. Yes, OTQs, a lot of, and you know that I told you OTQs are of 2 types. Even each part, section A, B, or C, 3 sections of the paper. Each section has around 50% weightage, around 50% question marks, 50% question are theoretical discussion, theoretical topics, questions. Theoretical questions means where you don't have to do calculation. In objective test question, they give a statement and then 3-4 options, and you have to select 1 or 2. So there is a problem. If you do not prepare these well, there will be a problem. So around 50%, I'm telling you. And you will suffer if you do not follow this properly. Now, so students, now how we will be studying? Student, I will be giving you notes, course notes. 2 volumes I have, course notes, which will be sufficient to prepare for the exam. But what I want you to do is, that is exam kit. What I want you to solve Kaplan plus BPP. I will try to arrange both for you. Both have to be solved for OTQs, section A and B. And one kit we can solve for section C, that is enough. That is enough. But you have to solve both. Mastering the OTQ, maximum practice, and additional resources on ACCA exam platform. If you do all this, which I'm telling you, there is no power on earth which can become a hurdle in passing your FM exam. Yes. And one more thing. This is what you have to do. So for this purpose, what are the efforts to be done? Efforts to be done. Or practical steps to be taken by you people. So the number one is attend live class. It is a must. We have been teaching since 5 years online. And I personally have tutored more than 2,000 students online. Online only. This is my experience. So I have data. You know, we do an analysis. Data speaks itself. I can be biased. You can be biased. But the data tells its story itself. The students who miss live class, their chances of getting past, they start reducing. Why? It is very difficult to stay on track when you are not running live class and do things timely, prepare timely. Attend live class, a must. Second is for 3 hours live class, you will need 6 hours self-study after the class to prepare that. This is minimum. I know that. If I teach 3 hours to you people, it means you have to work 6 hours minimum. So for that purpose, what do you have to do? Just like you allocate time, that at this time I have to reach office. So at this time I must have to leave home. I need to take bus. I need to catch my university bus, or I have to attend live class, or I have to, means everything else schedule. So study schedule. Make a study schedule. Prepare a weekly study schedule for FM. When the allocate time slot, just like I have allocated time slots here in front of you, similarly, you allocate yourself. That what are the time slots I will be utilizing for my self-study of FM. And if you are not doing that, let me tell you, it means you saying, okay, I will see, I will adjust. Then you will not adjust FM, because then FM is your last preference in all your schedule. And if you find time, then you can do it. No. So prepare a weekly schedule from tomorrow onwards and stick to that. Reflect, follow that strictly. At least 6 hours, allocate 6 hours weekly. You can identify 3 hours I can study on Saturday, for example. 2 hours I can study on this day and this day, like that. Now, next. And then students, practice the question and examples done in class at home, along with similar questions from exam kit. Weekly. every week. Weekly, you must have to do that. I hope it is clear. So this is what I want you to do. So theory, I already have told you to focus, special focus that. Now, so students, this is the process we will follow. This is how we will proceed with financial management subject. If you people have any question, please ask. And one more thing, during the class, I will ask you again and again one thing. Guess what? That is it clear? Any confusion? Please ask. Are you able to understand it? So what I want from you is, I want you people to respond my question. My preference is you respond, open the mic and respond. Yes or no. And or if you think that you cannot, then you can type yes or no, because I cannot see your faces. So I cannot read your body language, facial expression. I cannot read that whether you have understood the topic and the point or not. Now, so students, any question so far? Anyone, any question? Please.
Yes, sir.
Yes, hello. Okay, right, now. Okay, right. Thank you. Let us proceed further. So students, we are starting investment appraisal section of the syllabus first. So the volume 1 is in your hand. Yes. Investment appraisal. Here we are. So what investment appraisal is? You know, it is basically investment of long-term, appraisal of long-term investment, capital investment. When the business have to invest a huge amount of money. So capital investment appraisal. Students, a lot of money have to be invested and the funds are precious. So once you invest, you cannot reverse it. So you have to be carefully think whether it is strategically, it is in line with your business objective, organizational objective or not. So you know that there is a budget, capital budgeting cycle or a capital budgeting process. Big organization I'm talking about. That how do they prepare capital budgets? And what is the process? First of all, what are the investment to be made? New plant, new product, new market, where they have new branch have to be opened. So what is the investment idea? So either management themselves think, brainstorming, right? Or it comes from the market opportunity. So origination of idea is the first step. That what investment? So investment list is prepared. List is prepared. That these are the investments we can make. And then out of those, these are presented in the normally board of directors, that list. And those investment opportunities which are against the organizational objective. For example, an educational organization, they cannot start fried chicken chain, fast food chain, because it is not in line with organizational objectives. It does not fit with that. So first of all, screening that whether projects, this list we have prepared, the project A, it is in line with our organization overall target objectives. Okay, proceed. Otherwise, discard. So screening is done. And through accounting rate of return, it is a method of investment appraisal. Financial appraisal now. No, it is a financial appraisal being done. Simple payback period method. We have to study. That is calculated. There is detailed evaluation. Detailed evaluation is done. That is through further techniques. Financial. We have to study these techniques. And very important, legal aspect, social aspect, environmental aspect, ethical issues involved. For example, they are going to launch a new water filtration, mineral water, they are going to sell. So whether that plant has negative impact on society, they're going to emit some carbon, for example. What is the impact? So detailed evaluation is done. So once it is passed through detailed evaluation, then implementation phase. That financially fit, other aspects, it's good. Okay, implement it now. And through implementation, now monitoring has to be done. That whether financial targets, environmental targets, non-financial other targets, they are being achieved or not. Monitoring has to be done. What was predicted, forecasted, that is being achieved or not. Then is post-completion audit. Once project is completed, post-completion audit. Now, audit is done. Of that project. Learnings are documented. If you have learned something, some new techniques, new ways, so you should document that so that everyone in the organization can utilize that. If you have done some mistakes, document that to avoid those in future. So capital budgeting process is a 5-step process. Now, so students, now we are starting investment appraisal techniques. It was theoretical topic is done, 1. Now, investment appraisal techniques. Investment appraisal techniques. Now, so investment appraisal techniques, what they are? There are 5 investment appraisal techniques in your syllabus. One is payback period method. Yes. Method, which is also called simple payback. Accounting rate of return. And then is discounted payback, NPV and IRR. Now, students, these two are called non-discounting techniques. These were called non-discounting techniques. And these 3 are called discounting techniques. Now, discounting techniques. Yes. Now, my question from you is, okay, before that, what are the discounting techniques? Discounting techniques are those techniques in which time value of money is considered. Time value of money is considered. Discounting techniques in which time value of money is considered. And what are non-discounting? Where time value of money is not considered. Now, my question from you is, what is time value of money? Have you heard about it? Anyone, please. I need your contribution. Tell me, please. Tell me, what is time value of money? Okay, right. Anyone, please. Anyone else? More answers. And one person responded. I need answers from everyone. Please. Inflation. Okay, good. Right. Yes, please. Okay, inflation. More answers, please. Exactly. That today's money has more worth than tomorrow. The money you will get tomorrow. The money, the value of money is more today than it will have, the worth it will have. Yes, Ashwini as well. I appreciate. This is time value of money. The reason, the value or worth of money today is more than its worth to be tomorrow. Now, what is the reason? So this is called time value of money. So this is the definition of time value of money. Students, why this worth is more? The one factor one student told here, yes, Arzina told that due to number one factor is inflation. Factor number one. Yes, thank God. Due to inflation. Second is the opportunity for investment. You can invest today and double it till tomorrow. But if you tomorrow receive, that will be the same amount. Opportunity for investment. And third, that is risk or uncertainty. That today you are getting something. That is for sure. Tomorrow you will get it or not sure. that is not sure that you are going to get tomorrow. So time value of money. So this time value of money, how it is considered? By discounting, it is incorporated. It is incorporated by discounting and compounding the amounts. So in the discounting techniques, they are considered time value of money. Here it is not considered. Okay, now let us start. Accounting rate of return. The first technique, I will start with it. ARR results. It has another name. That is ROCE, return on capital employed. Return on capital employed, ARR. Return on capital employed. Now, next. What is accounting rate of return? It is the return percentage return on average earned amount invested. Percentage. It is the annual here, sorry. It is also called APR, annual percentage return. Another name is annual percentage return. Now, students, it is the only investment appraisal method which is profits based, in which profits are utilized. Now, example. So how it is calculated? ARR. How it is calculated? Average annual profit divided by average investment. Cross 100. Yes. Average annual profit. Let us study example. For example, a project X, because it is future project which is to be launched. Year 0, 1, 2, 3, and 4. So, for example, profits forecasted, they are 230 million, 410 million, 390 million, 225, and 185. Initial investment, for example, that is 1250 million, and residual value of the project at the end, that is 40 million. Students, we need to calculate ARR. First thing we need is average annual profit. equal to sum sorry 4 year it is. Yes, divided by 4, sum of the profit divided by 4. Where this 4 came from? Number of years. Average annual profit, sum, add the all profits divided by 4, number of years. Average annual profit. Next is average investment. Next is average investment. Now, what is the formula for average investment? Listen, please. Average investment is calculated like this. Equal to initial investment plus scrap value. Initial investment plus scrap value divided by 2. Divided by 2. Now, just see here. So, initial investment plus scrap value divided by 2. So, here is the average investment. So, accounting rate of return. This formula now we can apply. Average annual profit divided by average investment multiplied by 100. Yes, 48.6%. Now, students, before I proceed, wherever you get confused, you think that you are unable to understand a formula, a calculation, don't hesitate. Immediately buzz in the chat box. Open the mic and speak to me. Or in the chat box, tell, when you type question, it takes time. It takes time. Okay, you can do that, typing. But I suggest to you people that open your mic and talk to me immediately. I'm ready to re-explain. Now, tell me, is it clear? ARR is clear? Okay, right. Now, let us proceed further. Let us proceed further. Students, if ARR of a project is greater than target ARR set by management, we say accept the project. Management director set a target that this should be the ARR. Okay, we accept the project. If less than, otherwise reject the project. Otherwise reject the project. Otherwise reject the project. Now, next. Now, next. Example. Now, student, it is your turn. You need to practice this calculation in the Excel sheet, and sometime in exam, you may have to do it on calculator as well, on OTQs if it is tested. So, for example, is project Zeta. Year 1, 2, 3, 4, 5, and 6. Now, these are the profits of project forecast. Profits. Initial investment is, that is, for example, $5,000. And scrap value is, that is 100. I want all of you to calculate ARR for me. Be quick, please. ARR for this project. Be quick, please. Accounting rate of return for this project. Be quick, please. I'm waiting. So I'm calculating it in front of you people. Yes, here we are. 36.17%. I appreciate. Now, so this is accounting rate of return. Accounting rate of return. ARR. Students, advantages of this method and drawbacks. Advantages. The first advantage of this method, advantages of ARR method of investment appraisal. If we use this, it is based on profits which are to the data which are readily available data. Yes, that is not something difficult to find. That is not something difficult to find. Second, can you, yes, a good question, Toshini. Can you please send your question to everyone? A very good question it is, so that I can answer it properly. Everyone then will understand better. Can you send it to everyone, please? Yes. Remember, in section C of the paper, there is no such compulsion. That is your choice. But section B, we have to see requirement. In the requirement, they must have told you that 2 decimal point, 1 decimal point, rounded off to near thousands, and follow that. Got it? Is that clear? Good. Welcome. Welcome. Next. The next point is advantages of ARR. The next advantage. It is easily understood by business manager. Yes. Decision criteria is simple. Decision criteria is simple. Now, disadvantages. Profits used in ARR may be manipulated by management. Yes, profits may be manipulated. So ARR may not be correct. Second, we have already considered, it does not consider time value of money. It does not consider. Target ARR is set based on judgment of management. Now, what is a good target ARR for decision? It is a decision of management. And when judgment is involved, that may not be appropriate. That may not be appropriate. Now, it is a relative measure which does not consider size of project. Note it down, I'll explain. What does it mean? You know that. Relative measure. Relative measure means which is giving answer in percentage. Giving answer in percentage. You know that two projects, for example, project A and project B. ARR. It has 45%. It has ARR 25%. Based on this data, which one should be selected? A, higher ARR. So project A should be selected. Based on data, but annual profit. What is annual? For example, project A annual profit is average annual profit. Average. For example, that is 2 million and 20 million. And here it is average annual profit is 1200 million. You see here. So ARR is saying select this, but average and size, how big is the project? How big is the profit? ARR is not giving the right, inside of that. This last point is clear. Is it clear? Now, one advantage, it considered full life of project. Yes. Full life. For all years we consider. Now, so this is called accounting rate of return. Now, next. Students, the next method of investment appraisal is payback period method. Now, all other are cash flows based. Cash flows based method, not the profits. Students, what is difference between cash flow and profits? Cash flows less non-cash expenses, we get profits. Means when we calculate profits, basically non-cash expenses are deducted in the profits calculation, while in the cash flows they are not deducted. So it is cash flow based method. And what is payback period? Time taken to recover initial investment of the project. That is called payback period. Time taken to recover initial investment of the project is called payback period. When I'm going to invest in a business, what is my first interest? What is my first interest? The first interest is that whether with the funds which I'm investing, that will be recovered or not. The funds I am investing, whether that will be recovered or not. This is first concern. Or in how much time they will be returned. For example, in a project, I need to invest is 1,200 million. Now, I'm going to apply for a bank loan. Bank says we will give you a loan of 3-year loan. Now I need to check whether the project will return me 1,200 million in 3 years or not. If project is not going to return me 1,200 million in 3 years, I cannot proceed with the project. I cannot. So students, I need, so that is called a payback period. That in how much time initial investment of the project will be recovered. That is called payback period of the project. Now, so initial investment is 1,200, for example. So I'll say, for example, a project beta. So cash flows. Year 0, 1, 2, 3, and 4. For example, 1,200 investment in year 0 now, and cash inflows will be 345, 495, and 370. Sorry, 370 and 440. What is the payback period of the project? We need to calculate cumulative cash flows column here. Cumulative cash flow column. Cumulative means total to date. Total to date. So total to date is 1,200. 1,200. Now, next year, negative this, and this will be recovered. 345 will be recovered. So the net will be negative this total to date. Now, out of this, 495 will be recovered. 360. Let me make it 570. Okay, for clarity purpose. You see here, 2 year complete. Now we need 360. Next year it is 570 we will be receiving. 570. It means part of year 3 will be required to recover this amount. Part of year 3, not full year 3. How much part? We need 360 into divided by 570. Yes. $360 we need. The next year we will be having 570. Here we go. So 2.63 years. We can convert into months as well. So simply multiply 0.63 into, there are 12 months in a year. So 8 months. So 2 years and 8 months. How I calculate this? Here it is. So the payback period of this project is 2 years and 8 months. The bank is asking us 3 years. So it's okay. We can proceed with the project. Now, so here we go. Again, if payback period of project is less than or equal to target payback, target or required payback of company, simply accept the project. Otherwise reject. Otherwise reject the project. Otherwise reject the project. Now, so students, project S, there is project S. Cash flows are as follows. Year 0, 1, 2, 3, 4, and 5. Investment is minus 3,500 million. 890. 1150. 1490. 1550 and 1620. These are the cash flows. My request from you is calculate payback period of the project. Calculate payback period of the project. Be quick. Good. Yes, please. I have received 3 different answers. from 3 different students. I need more answers. Okay, right. So days, you need not to calculate answer in days. Okay. So let us prepare cumulative cash flows column. No issue at all. This plus this. Learning by doing. You will do mistakes here and learn. 2 years. We need 1460. Here is 1490. So how many years? 2 years complete. And 1460 we need, here is 1490. 2.98 years. $2.98 years. This is good. Now, next. In the months, we can also convert 2.98 years. Is it clear to everyone? Have you tallied your answers? Is it clear? Good. Now, so let us proceed further. Student, if there is any confusion, please ask. If there is any confusion, please ask. Advantages of payback period methods. Of investment appraisal. The first one is, it is cash flows based method, which are more reliable. Which are more reliable. Second advantage. So cash flows are more reliable because they cannot be manipulated. Profit can be. You can increase or decrease non-cash expense and manipulate. Now, it helps to reduce risk of business by recommending projects with shorter payback period. It helps to reduce the risk of business. It recommends accept that product has shorter payback. Shorter payback means less risk, timely recovery of the amount. Now, let us proceed further. Third, okay, let us write drawback first. Drawback. It does not consider time value of money. It does not consider. It encourages excessive investment in short-term projects, and business may lose its long-term focus. Yes, short-term projects. It says accept those projects which are short-term. So long-term business focus may be lost. Long-term business focus may be lost. Now, next. It ignores the full life of project. And hence, cash flows after the payback period are ignored. Note it down, I'll explain with example. So just see here, two projects, project A, project B. Here 1, 2, 3, 4, 5. Investment is, for example, 100 million in both. $30, $40, and 30. 20, 10. Cash flows. 40, 40. Sorry. Make it 30, 30, 40, 50, 70. What is payback period of each project? Payback period, if we calculate for both projects, it is 3 years. 3 years each. Both projects have same payback period. But 3 years here locked. But what is happening after year 3? Payback period is not considering that. It is not telling us select B. No, it is not telling us that. So it ignores full life of project. They are ignoring that. Now, so students, it is, so hence it is not able to differentiate between these two projects. Which one should be selected? Payback period is not telling the solution. Now, so these are the drawbacks. I think it is clear to you people. Let me open the notes in front of you people. Here are the advantages and drawbacks. Very easy, very easy. Means which are more technical, I'm discussing with you. Okay. Yes, project with the same payback may have different cash flows. Same payback, 3 years. $30 and $40. Their payback period is same, but cash flows pattern is different. Cash flows are different. Cash flows are different. Now, next. Let us proceed further. Students, let me open the here. So payback, ARR done. Compounding and discounted. Discounting payback. Okay, right? Discounted payback. Period method. Students, we said it ignored the time value of money. So discounted payback period basically removed this flaw. Removed this flaw. So this is the project. For example, cash flows are 2,500 negative. Yes, 950. 1050. 750 and 800. Students, calculate payback. Be quick. Simple payback. Calculate for it. Be quick, please. Give me answer. Simple payback. Be quick. All right, now, so cumulative cash flows. Cumulative cash flows. This plus this. This plus this. Okay, so 2 years and 500 divided by 700. So 2.7 years or 2 years, and we can say this into 12. Sorry, my mistake. You are right. Yes, 2.67. Yes, 2 years and 8 months. 500 divided by 750. So this is the payback period, simple payback. But what is discounted payback? What is discounted payback? Students, what I'll be doing? I'll be copying these cash flows again here. For example, cost of capital is 10%, discount rate. So discount factor at 10%. 1.909. This will be available, discount table will be available to you in the exam platform. So present value, this into this. So present value of cash flows. Here we are. So cumulative cash flows column will be prepared on this column now, on the present value, time value of money. This plus this. This plus this. This plus this. So 3-year complete. And how many? 206 divided by 546. So 3.38 years. Or 3 years. And how many months? This into 12. 3 year and 5 months. Note it down, please. Yes. Now, Let us proceed. Student, is it clear? Discounted payback. Is that clear? Now, next, another example. So cash flows of the project are here. Cash flows of the project are here. These are the cash flows of the project. So what is the, for example, cost of capital is 12%. We need to calculate discounted payback of the project. We need to calculate discounted payback of the project. How to calculate? Now, so students, present value at the rate of 12%. Students, there is a formula for present value. You may have studied in F2 or F3. Future value into 1 plus R, discount rate, raised to power minus N. 1 plus R raised to power minus N. One plus R raised to power minus N. Now, so students, you see here, one way, this was one way. Yeah, you write manually discount rate, multiply and calculate present value. This is the other way. This future value into 1 plus R, R is 12% here, discount rate, raised to power minus N, N is number of years. Note down this formula. Apply this formula. Shortcut. Students, now simply drag it. Life will become easy. Then you will prepare cumulative cash flow column. Cumulative cash flows column on it. This plus this. This plus this. Now, 2 years. 3 year, part of 3 years. 3692 3915. So 2.94 years. $2.94 years. Is it clear? Tell me, please. Only 2% respond. Other people are not responding. Why? If you have confusion, please ask. Okay, now, so students, so we have discussed discounted payback. The next topic is NPV, net present value. Net present value. NPV. What is net present value? Students, very good method, very important method of investment appraisal from exam point of view. So NPV tells exact impact of a project on shareholders' wealth. On shareholders' wealth. Now, what will be the impact of project on shareholders' wealth? Whether shareholders' wealth will increase or decrease. Due to a project. Impact of a project on shareholders' wealth. Now, next. So students, you see here the story. You invest 1,200 million in a project. Investment. And you borrow this money. You take this from shareholders. The project gives the cash flows. 1, 2, 3, 4. 4-year cash flows. For example, net cash flows. After deducting all expenses. They are 550, 450, 430, and 650. For example, what is the first thing? You have to pay regular expenses of project, which you have already deducted. Net cash flows you get. All costs you deduct. Now finance cost you have to deduct. Cost of funds. How you deduct? You calculate present value. For example, cost of capital is, that is 12%. Okay. So you deduct now this cost. Present value, this into 1.12 raised to power minus 12. This. Same formula I applied. This one. Future value into 1 plus r raised to power minus n. Same formula. Here we are. Simply. Now, next. So students, next. So present value of cash inflows. Present value of cash inflow. So NPV, that is equal to cash inflows minus investment, 1200. This is the net present value. I will explain it now, the conceptually. Now, so you see here, we invested this money. We deducted finance cost through present value of cash inflows. Then we repaid initial amount. Now we have remaining this amount with us. Positive NPV means that this amount is still with us. So positive NPV means shareholders' wealth will increase by this amount. By this amount, shareholders' wealth will increase by this amount. Positive NPV. Now, by this amount NPV, shareholder will increase. So that's why it's if NPV of project is positive, we say accept the project. Why accept? Because wealth of the shareholder is increasing. And if NPV of project is negative, we always say reject the project. Why reject? Because project is unable to recover its own cost or its own repayment. Wealth will reduce. Wealth of the shareholders will reduce because of it. Now, next. I hope it is clear to you people. Advantages of NPV. It is cash flows based. Cash flow based technique. Cash flows based appraisal methods. Yes, it is cash flows based. Strength. It considers the time value of money. Discounting is done. It considers the time value of money. Third, it is an absolute measure and tells how much wealth of shareholders will increase or decrease due to a project. How much reduction or increase? How much? So it is telling wealth will increase by this million, 369 million around. Exact, absolute means exact amount. Disadvantages. Of NPV methods. There are one or two more advantages, but I will tell you with the time. They have been in comparison with other techniques. Some drawbacks. Yes, it is difficult to for business managers to understand it. This method for business manager, it is difficult. Conceptually, it is difficult. Conceptually, it is difficult. Now, students, yes, it considers full life of project, life and size of project as well. Both advantages. Full life. Now, Students, today is the first lecture. So I deliberately keep the first lecture a bit short because students normally it takes time to assimilate in the class. So by the way, we have done today's task. Whatever is as per the course plan, that is the discussion of, yes, here it is. We have discussed all these points. In the next class, discussion will be a bit more tricky. IRR, annuity perpetuity, and some adjustment of NPV. So this will be the topic in the next class, but I request you people that prepare this lecture very well before coming for the next class. Okay, so that we can do, and in the next class, most likely I will touch the exam kit, some objective test question as well. Any question from your side? Any question from your side? Yes, please. So that's it for today. In the next class, we will continue on 17th. So then these notes, you can revise these topics, and you can, raise your questions even. Yeah. Here we are. These are the top questions. Page 34 to, I urge you, 34, 5, 6, and 37. Okay. So no, need not to buy. I will provide. I will try to best to arrange it for you. Need not to buy. Soft copy, I will arrange. Okay, some for you. Need not to buy. Okay. Okay. Thank you. So you have the number of coordinator as well as those who have not enrolled yet. Kindly enroll. So in the next class we'll meet and we will continue. Thank you for joining. Take care. Goodbye. Goodbye. Thank you. Goodbye.